Today is the 3rd of October 2022. My name is David Hickson, and in today's market update we're going to be taking a look at the S&P 500 again. Thank you very much for all your comments and feedback to last week's market update. I realized going through the comments that I was perhaps not clear enough about the bigger picture of what we are expecting in the S&P 500, which is why we are taking a look at the S&P 500 again today. Here is the primary analysis that we've been tracking for many months in the S&P 500. This is data for the SPX, which is of course the same underlying instrument. The important thing about the analysis that we've been looking at is that we have an important trough in March of 2020, which is a trough of at least 54-month magnitude, in my opinion. And then we have the 18-month cycle trough over here, right at the beginning of October last year. Recently, we have experienced the 40-week cycle trough over here in about the middle of June. The market is now moving down towards this 20-week cycle trough, which is expected later in October. In last week's market update, I spent some time discussing possible positions for the 80-day cycle trough. You can see that in this analysis it has been positioned over here. I am a Hurst cycles enthusiast and I love discussing possibilities and so forth, but the point that I wished to make in last week's market update might have been missed by some of you, which was that no matter where we position the 80-day cycle trough, the important thing is that we are heading down into this 20-week cycle trough. Some people, I think, interpreted the various possibilities I presented as indicating some confusion or lack of clarity, but nothing could be further from the truth. And this brings me to a really important point about the robust nature of performing a Hurst cycles analysis. Sometimes I get a little caught up in the weeds of discussing the details of where particular cycle troughs might be, because that kind of thing really interests me. But the important point when it comes to using Hurst cycles as an analysis tool is that very often it doesn't really matter where you position certain cycle troughs. The bigger picture and the implication of the analysis remains unchanged. And that is the point that I didn't make clearly enough last week, but it is the point that I wish to express today. So let's take a step back and consider again the slightly bigger picture when it comes to the S&P 500. According to this analysis, we are in the second 18-month cycle of the current 54-month cycle. The first 18-month cycle, of course, started here in March of 2020 and formed its next trough over here at the beginning of October last year. That was also the start, of course, of the second 18-month cycle, and the important thing, and perhaps the most important message that you need to take away from today's video, is that in the slightly longer term, we are expecting the markets to move down into an 18-month cycle trough expected early next year. I had several people comment that when price bounced out of the 20-week cycle trough, we should consider going long. I think that might be a mistake. Of course, it depends on your time frame. If you're a day trader and you see signs that price is bouncing out of a 20-week cycle trough, even in a bearish market, you will want to take advantage of that. But if your perspective is a little bit longer term, then price bouncing out of a 20-week cycle trough at this point is not really a bullish long trading opportunity. Why is that? Well, let's take a look at the shapes that have been formed in the markets because of these cycles. I often speak about the shapes that cycles create in financial markets. They are, of course, M shapes when the cycles are synchronized at their troughs, which is the principle of synchronicity discovered by Hurst 50 years ago. Let's consider the cycle shape for the first 18-month cycle. We had a move up to the peak, and then a move down to the 40-week cycle trough over here, and then another strong move up to the second peak of the cycle, and then a small move down into the 18-month cycle trough. You can see that that is a very distorted M shape. The distortion of the M shape reveals the bullishness or the bearishness of the market. That was clearly a very bullish 18-month cycle trough. There are two primary ways in which we measure the bullishness or bearishness of a cycle shape. The first is, of course, how much the market is moved up over the course of the M shape. this market was moved up by over 2,000 points, which makes it a very bullish move. The next measure that we use is where the peak is in the formation of the M shape. An M shape has two peaks, of course. There is the first one, and then there is the second one. The later that a peak occurs, the more bullish the cycle shape is. And so here is the peak of that 18-month cycle. It is very late in the cycle. If you measure the time from the first trough to the time at which the peak formed and compare that to the time that elapsed from the peak to the second trough, you can see that the peak occurred very late in the cycle. That makes it a very bullish cycle. Now, that was not unexpected because of the magnitude of this March 2020 trough. Because we had a trough of at least 54-month magnitude, and some analysts might argue the fact that it might have been a 9-year cycle trough, we had pressure from longer cycles. When you have longer cycles pushing upwards, then of course you will end up with fairly bullish shaped shorter cycles. Now let's consider the shape that has elapsed so far in the current 18-month cycle that started in October of last year. We had a move up, and then we had a move down into the 40-week cycle trough over here, according to this analysis, in the middle of June. Then we have a move up to the second peak in the M shape. What is happening now is that price is clearly moving down into the next 18-month cycle trough, which is expected early next year. That is the bigger picture of what is happening. We are clearly in a bearish run at the moment. And so although we are looking for a 20-week cycle trough to occur in the market, that is not necessarily going to be a particularly good long trading opportunity. Although this cycle shape is not yet completed, we can measure the ongoing bearishness of the cycle because of the fact that price has, of course, already been brought down by a little under 1,000 points. So that is clearly bearish. The next point that makes this a bearish cycle shape is the fact that the peak occurred early in the development of the full cycle shape. An early peak indicates a bearish cycle shape. Now let's zoom in and take a look at some of the detail of these cycle shapes. Let's consider the cycle shape of the 40-week cycle. Here is the move up to form the first peak, then the move down into the 20-week cycle trough, move up to the second peak, and then a move down into the final 40-week cycle trough of that cycle shape. Again, we have our M shape, and it is clearly a bearish M shape, bringing price down to a lower level and with an early peak. Now let me adjust the scale a little bit, and let's consider what we are expecting out of the current 40-week cycle. Let me just remind ourselves of the cycle shape that elapsed over there. What is the next cycle shape expected to be? Is it going to be more bearish, or about the same, or more bullish perhaps than the previous cycle shape? The 18-month cycle is an interesting cycle because of the fact that it has a 3-to-1 harmonic ratio with the 54-month cycle. It is just possible that this trough expected early next year could be of 54-month magnitude. I've discussed this in previous market updates, so I'm not going to dwell on it here, but let's assume for now that it is only an 18-month cycle. What is our expectation? Our expectation is that the current 40-week cycle would then be at least as bearish as the previous one. In other words, we are expecting price to come down into a lower level and to continue to experience early peaks as it does that. And so again, we are definitely in a bearish phase as the market comes down into this 18-month cycle trough expected early next year. If it is true that the 54-month cycle trough is going to occur synchronously with that trough early next year, then the bearishness would be even more extreme. And so let's focus in again on even more detail and consider what we are expecting as price comes down into this 18-month cycle trough expected early next year. As I've mentioned, we are witnessing price moving down into the next 20-week cycle trough. Here is the nest of lows for that next 20-week cycle trough, expected at about the end of October. Here is the nest of lows for the 40-day cycle trough, and so our expectation is that price is going to bounce a little bit out of the 40-day cycle trough, but effectively continue downwards into a 20-week cycle trough expected towards the end of this month. Then we should see a bounce out of the 20-week cycle trough, but we would then expect again an early peak, because this 20-week cycle should be more bearish than the previous 20-week cycle. The reason for that is because in the previous 20-week cycle that elapsed from the middle of June, the 40-week cycle was rising upwards. If we display the semicircle for the 40-week cycle, it gives us a useful way of understanding the influence of that particular cycle. You can see that during this period of time, the 40-week cycle was pushing upwards. During the period of time that is going to occur after the formation of the next 20-week cycle trough, the 40-week cycle is of course going to be pressing down. And so for that reason, we expect the next 20-week cycle to be more bearish than the previous one, or the current one. That would indicate an even earlier peak and a stronger move down. And so our expectation is that the market is going to form a 40-day cycle trough fairly soon. You can see that there have been 108 bars that have elapsed since the trough in the middle of June. The average length of a 20-week cycle discovered by Hurst 50 years ago is 136 days, which means that we should have about another 28 days to elapse before the 20-week cycle trough forms. We would expect price to bounce out of the 40-day cycle trough. It would probably not be a very impressive bounce because, of course, the markets have been fairly bearish. We would also expect an early peak because this next 40-day cycle should be a fairly bearish one, bringing price down into the 20-week cycle trough expected towards the end of the month. Now, I mentioned earlier that a Hurst cycles approach is a fairly robust approach. What did I mean by that? Well, you can see that we are expecting a 20-week cycle trough to form towards the end of the month, as discussed. What would be our expectation at that point? Let's assume that price does form a trough and it bounces up again. We would expect an M shape to unfold. As I've mentioned, it is likely to be a fairly bearish M shape with an early peak and bringing price down lower than the start of the M shape. And so we would see something a little like that as price comes down into this 18-month cycle trough. When we are wrong with our Hurst cycles analysis, we are usually wrong only by a matter of degree. What I mean by that is that looking back with the benefit of hindsight, we might say, well, this trough over here was not actually a trough of the 40-week cycle, but was perhaps only a trough of the 20-week cycle. Or perhaps we might say it was a trough of the 18-month cycle. That is what I mean by a matter of degree. The fact is there was still a trough in the market. And so when it comes to the next 20-week cycle shape that forms in the market, what could go wrong? What could go wrong is that the magnitude of this trough would not be correct. The chances are very high that we will still experience a trough forming in the market. But if we have the magnitude wrong, then if it is only an 80-day cycle trough that does form, then we will witness a more bearish move as price comes down. The structure of the move, however, will be very much the same. If we have our analysis wrong in the other way, and the magnitude of the trough that forms at this time is greater than 20 weeks, then instead of experiencing a bearish cycle elapsing, we will instead possibly see a bullish cycle elapsing. So why is this a robust approach? The most likely situation to occur is the one that I have been describing. But if it turns out that we are wrong, we will still see the same structure of move. In other words, price bouncing out of a trough, forming a peak, then moving down, then moving up again and down again, and so forth. The only difference is the degree to which it will move up and then move down again. As this next 80-day cycle trough forms towards the end of this year, we can reassess the analysis and we can ask ourselves, where is price now? If price is, as expected, at a lower point, then we can say our analysis is on track. If it is even lower than might have been expected, we can say, well, it's more bearish than expected. But again, our analysis is on track. If, on the other hand, we have witnessed a bullish cycle shape forming, at that point we might question the magnitude of the trough that has formed. We might have missed a good trading opportunity. But at this point we can reassess and take advantage of the next trading opportunity if that occurs. The important thing, in my opinion, is to use the Hurst cycles analysis to gain insight into what we expect and to be prepared for the upcoming market move. And in this case, the message is very clear. Although we might experience a bit of a bounce out of this 40-day cycle trough, we are still looking for the 20-week cycle trough lying ahead of us. The market is bearish, and so we would expect a bearish cycle shape to elapse in the next 20-week cycle, bringing us into the 18-month cycle trough expected early next year. I do hope you found this market update useful and interesting. If you have any questions, please join us on our Hurst Cycles Discord server. And of course, you are very welcome to put questions in the comments below this video.